Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Paul Binnion, Chief Revenue Officer of Hanlon, to discuss creating more efficient tools for financial advisors to more effectively manage their practices. Paul, it's great to see you again. Welcome to Trade Talks.
Thank you, Jill. Hello.
And that certainly has been a trend, seeing advisors outsource so they can focus on what they do best, manage clients. Tell us more about how advisory is embracing the increasing role of technology and outsourcing.
So obviously we've got this serious fee compression in this industry, Jill, and what's happening is the amount of money a client is willing to pay is dramatically decreasing. Vanguard being a leader, BlackRock, ETFs, so forth. So what's happening is advisors are finding the need to outsource and to use technology to replace human technology and the cost and structure of that. I think also advisors are finding that technology is a much more reliable source to grow the business. CRMs, client relationship management systems, platforms, all kinds of information systems, retrieval information is important. This is allowing the advisor to spend more time with the client. So technology has allowed the advisor to be more efficient with their time, more efficient with cost, ultimately bringing a better solution to the retail client, of which there is about 80 million baby boomers. That's the big elephant in the room. That's who everyone's looking at and saying, how do I target this group? What do I need to do? What do I need to charge? How do I use technology?
Where does Hanlon fit into the financial planning ecosystem?
Well, so what we are is we have a fork in the road, Jill, and a very, very obvious fork. As an advisor, you have a decision to make as you leverage your time, and do you do it as a collaborative effort working with firms like Hanlon as a TAMP, a turnkey asset management provider? Or do you take the other fork in the road and become more of a portfolio, what they call advisors, portfolio manager, using the InvestNets and the Orions and those kind of platform systems, your broker-dealer platform? So in other words, do you want to do it yourself? In that you're basically not necessarily building the portfolios, but deciding what portfolios you want to use with no collaboration, or do you want to have a partner in doing that? Hanlon is the partner, we're the TAMP. The other thing too is, I don't want to bring in Reg BI or necessarily fiduciary responsibility and acknowledgement, but let's face it, this is where we're going, and a 4-year Democratic led government is going to probably lean more into that. If you're an advisor and you're managing your own money, meaning your own platform, choosing which funds and ETFs or models you want to use, you by definition have a higher level of fiduciary responsibility than if you're using a TAMP who accepts some of that liability with you, helping you build. So we've got the compliance side, but more importantly, where Hanlon's coming in saying, you as an advisor, probably post 50 years of age as an advisor, which is the majority, that you're trying to find a way to leverage, grow your business, spend more time with your family perhaps. Hanlon is an answer to that. As a turnkey asset management provider, we can actually do a lot of the things advisors would normally have to do on their own.
Yeah, it's an interesting point that you brought up about the administration and how potentially regulations could become a little bit more strict around the fiduciary responsibilities. So then what differentiates Hanlon as a TAMP from other platforms?
Well, I think a TAMP in and of itself is different from a platform. A platform is literally just a conduit. The analogy we use, Jill, is think of Home Depot or Lowe's as compared to a do-it-yourself hardware store, a little family hardware store. A platform is nothing more than a repository of asset management ideas and portfolios that an advisor goes and basically chooses off of those. Sometimes they'll have model portfolios, but in essence, it's a do-it-yourself platform where the advisor is literally trying to lower the costs and increase some form of leverage. A TAMP, on the other hand, is more of a turnkey asset management provider, meaning we're doing more things. For instance, at Hanlon, we do a lot of work around the time segmentation of wealth, what we refer to as income planning. We're realizing, as most people are, with 80 million or so baby boomers, there's a growing angst around wealth. I don't think we've ever seen as much trepidation and fear around the wealth that we've accumulated. Here's the irony, by the way, Jill. We've spent 40 years almost in a perpetual bull market minus the 2000s, where we've been growing wealth more than any time in US history. And yet never in this country's history have you seen a larger group of people more scared about what they've created. What we do at Hanlon is we actually help advisors, help clients time segment wealth. When are we going to use different buckets of money? So what's happened is we're less about performance, alphas, betas, R squareds. and we're more about the human psychology. So we spend a lot of time on the behavioral finance side of our business, understanding what is going to drive a client to say yes to an advisor who's offering someone like us in a turnkey asset management platform.
That's interesting when you think about it from the wealth transfer generation aspect of it. I mean, you're going to see a generational amount of wealth being transferred over to a younger generation that typically embraces more technology-driven platforms and the robo-advisors and so forth. And you're going to have tens of trillions of dollars out there where, a younger generation might not understand what to do with these assets. And that's something that I think as an industry, we need to focus on.
We do. So again, here's that fork in the road, that proverbial fork. On one side, we've got an immense amount of opportunity. Never in the history of this country has the investing public needed advisors more than today. The decisions being made, long-term care, in life insurance, disability insurance, investing, buckets of money, all that. And then on the other hand, you've got this incredible amount of fear and angst that's driving people. So you see it across the spectrum of platforms, wirehouses, regional money management, national money management, ETF firms, is the amount of wealth in this country that's going to transfer is it's never been seen in world history. Mm-hmm. And everybody's realizing that in itself is a decision clients have to make. So once we get past the retirement, am I going to be okay decision, the next decision is, what do I do with all the money I've accumulated I'm not going to use? Which we find the irony of all this is, we have this great amount of anxiety around wealth, and yet about 85–90% of people we meet are going to have more wealth than they need. So the real question isn't really the income planning. The real question is transference of wealth, not the estate planning side of it, but do I really want to leave my children with $2 million, $10 million? And if I do so, where's the rule book on how they're going to use that money? Because I don't know about you, but most of us in our generation have not inherited large sums of money. So we haven't been spoiled or ruined by wealth that this generation, baby boomers, are concerned about what's going to happen to their kids. Will I ruin my kids' initiatives? Will I inadvertently create a trust baby without even trying? So we're finding a lot of advisors are dealing with now what we call the legacy issues, not the estate issues, but the legacy issues after they solve the income issues.
We have this conversation all the time in my house. And to wrap up here, how Hanlon also partners with Nasdaq Dorsey Wright. In what capacity do we work together?
So what we do is we are an outsourcer of wealth management to the best firms we can find. We, a number of years ago, realized that there's great money managers. Nasdaq Dorsey Wright is arguably the best money manager we have currently in our stable. We refer to Dorsey Wright as an alpha manager. The amount of alpha excess return over the indexes is pretty extreme and great. The other managers we use are primarily index-based. Dorsey Wright is not. They're primarily an alpha generator, as I said. So we do a lot of work. In fact, the majority of our clients' assets goes to Dorsey Wright simply because of that alpha. Now, our clients aren't necessarily looking to beat the market. In fact, I've not had a client in the 30 years I've been in business come to me and say, your job is to beat the market. They're pretty happy being the market. But anytime you can give excess alpha, it's like saying, I love you to someone more than once. They don't need it, but they certainly appreciate it.
That's a great analogy, Paul. Good to see you as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Jill. Take care.